In Chapter 9, we're covering long-term assets, specifically plant assets and intangible assets. Most of the chapter talks about plant assets because all companies are going to have plant assets. Not all companies will have intangibles. And we're actually not going to spend time on the natural resources piece. So we're talking about plant assets. They exist physically, so you can hold on to them. That's what makes them different from intangible assets. They're acquired for the use and the operations of the business, so they're not investments. So for instance, a company could have land in a building that they're holding as an investment, and that would not be a plant asset, but the land and building where their office is, that would be a plant asset. They're not intended for resale to customers, so they're not inventory. So I one time had a client that sold photocopy machines. And so out in their warehouse, they had photocopy machines. Those were inventory. They weren't plant assets. But the photocopy machines in their office that they were using, those would be the plant assets. And so we know we've got the cost principle. We've been talking about that. And so back in Chapter 2, we might have had a transaction where we bought equipment, right? And we would have debited equipment for its cost, right? What we paid to get it. So we think of cost as the purchase price, but it could also include other things. So any cost of acquiring the asset. So this gets more complex when you're talking about real estate. You could have things like taxes, commissions, title fees, okay? Also, any expenses needed to get the asset ready to be used. So installation costs, testing the equipment before you use it, the freight charges you have to pay to get the plant asset shipped to you, insurance that you pay while the plant asset is in transit. All of these become part of the cost. And so we'll debit the equipment or whatever the plant asset is for the total of all of these things. The cost of the plant asset does not include any unnecessary costs that don't increase the asset's usefulness. So vandalism, mistakes in installing, damage unpacking, these do not become part of the cost of the plant asset. Land versus land improvements. Okay, so we need to distinguish between the land and the things you put on the land, which are the land improvements. Because land is not going to be depreciated. It's going to have an unlimited useful life. Land does not go away. Okay, so we debit the land for the purchase price, and then, as I said, the expenses of acquiring the land, getting it ready to be used. So if you had to grade the land, or if you had to tear down a structure before you could use it, that would all become part of the cost of the land. The things you put on the land are the land improvements. So here are some examples: fencing, paving, lighting, signs. So these are going to be depreciated. That's why they're going to be in a separate account. Then we want to take a look at the distinguishing between capital expenditures and revenue expenditures. So revenue expenditures are expenses. We debit an expense for them. So costs that we're incurring that benefit only the current period. So these are maintenance type expenses, or costs, I should say, things that keep the plant asset up and running are called revenue expenditures. We'll debit a repair expense, a maintenance expense, an auto expense. Okay. And then capital expenditures. If you'll hear the term that you capitalize an asset, that means we're recording an asset. We're debiting an asset account. So when we're acquiring the plant asset, we will be debiting the asset account. Capital expenditures are expenditures where we're adding to improving a plant asset. Okay, so it's not just benefiting the current period. It's not an expenditure just to keep the asset up and running. Okay, it's more than that. It includes extraordinary repairs. So an overhaul that extends the asset's useful life. So here's some examples. If we add a new component to a plant asset, if we replace a component, That is a capital expenditure, and we will debit the asset account. So here's some expenditures, examples of some expenditures, and we're going to say whether or not they're capital or revenue. So the first one, we installed a security system on a truck. That would be a capital expenditure because that security system is going to last more than just 1 year. Okay. So we're adding it on to the cost of the truck. Same with installed a hydraulic lift on a van. That is going to last more than 1 year. That's going to be a capital expenditure. Repaired a flat tire on a van. That's an example of a revenue expenditure. We would debit a repairs expense. Okay, it's just kind of a repair that keeps the asset up and running. Replace a truck suspension system with a new suspension system that allows for delivery of heavier loads. This would also be a capital expenditure. That's going to benefit more than one period. Change the radiator fluid on a truck. That's a revenue. That's just a normal repair to keep the truck up and running. Removed a two-way radio from a truck and installed a new radio with a greater range of communication. That would be capital. That's going to be used for more than 1 year. Change the oil and grease the joints of all the trucks. That's a revenue expenditure. We debit truck expense. That's just normal maintenance. And then overhaul the engine on one of the trucks. This would be an extraordinary repair because we're going to, when you overhaul the engine, you're going to be able to use the truck longer. So those are examples of capital and revenue expenditures. A lot of times companies will just set policies. They'll set a certain dollar amount. If it's under 1,000, it's going to be a revenue expenditure. And that goes back to our materiality concept. It's not going to make that big of a difference if we take the expenditure in this year versus if we capitalize it, debit an asset account, and then take depreciation on it. So that can often be also a way to distinguish between capital and revenue, in addition to the textbook definition. So now we do want to look at depreciation. Okay, and we mentioned this back when we were talking about adjusting entries, right? Usually when I ask for depreciation, someone will say it's the decline in the value of the asset. And I say, no, well, that they're not wrong. That's the finance definition, but it's not the accounting definition. The accounting definition of depreciation is that depreciation allocates the cost of the fixed asset over the accounting periods that asset is being used to generate revenue for the business. Land is the only fixed asset or plant asset that is not depreciated. All the rest we will take depreciation on. And so depreciation is in accordance with that matching principle. We're matching the expense against the revenue that's being generated by that fixed asset. In order to compute depreciation, we need to know the cost. That's why getting the cost recorded accurately is so important. We need to estimate the residual value of the fixed asset. The residual value is the amount that we estimate we're going to be able to get for that fixed asset when we're done using it. So when we're done using it, perhaps we're going to sell it. What do we think the sales proceeds are going to be? That's the residual value. Perhaps we're just going to scrap it. Maybe we'll get scrap value for it. That'll be the residual value. Maybe we think we're just going to throw it away and we'll get nothing and we'll have a zero residual value. Maybe we're going to trade it in for a new fixed asset. And so whatever that trade-in allowance we get is going to be the residual value. So we're going to be estimating that. And then the estimated useful life. So typically this is going to be how many years do we think we're going to use the fixed asset? But one of the depreciation methods we look at is going to say how many units do we get out of that asset. So it's an equipment. How many units are we going to be able to make with that piece of equipment? And we already learned this journal entry back when we talked about adjusting entries. We debited depreciation expense. We credited accumulated depreciation. And in the adjusting entry chapter, we were told the amount of the depreciation. Well, now we're going to learn how to calculate the amount of this adjusting entry. And so we have three methods for calculating depreciation. Straight line, production, declining balance. Straight line is the most commonly used method for calculating depreciation, and that's nice because it's also the easiest one. So, our formula for calculating depreciation expense, and I would recommend that you write down these formulas for these three methods. So when you sit down to do your homework, you have the depreciation methods right in front of you. So this is how we calculate depreciation expense using straight line depreciation. We take the cost minus the residual value. And this amount is called the depreciable cost. Okay. So the depreciable cost, that's the portion of the asset that we're going to depreciate, because we don't need to spread the residual value over the useful life as depreciation expense because we think we're going to get that back. So that's why the depreciable cost is cost minus residual value. We're just going to divide that by the estimated useful life. So you see we're going to be spreading that depreciable cost evenly over the years that the fixed asset is going to be used to generate revenue for our company. So here's an example. We have a truck that costs $90,000. Estimated useful life 5 years, estimated residual value $15,000. And so we calculate depreciation expense by taking the depreciable cost, dividing it by the useful life. So our depreciable cost is the $90,000 cost minus the $15,000 residual value. That gives us $75,000 as our depreciable cost. $75,000 divided by 5 is $15,000. So we will debit depreciation expense, $15,000, credit accumulated depreciation, $15,000. Okay, we'll do that at the end of year 1. We'll do it again at the end of year 2. We'll make the entry again. Okay, so depreciation expense on the income statement is being reported at $15,000. Okay, accumulated depreciation, we said back in the adjusting entry chapter, accumulated depreciation is a contra account. It goes along with a related account and gets subtracted from that related account. Okay, so the accumulated depreciation is going to go along with the truck account. The truck has a cost of $90,000, so that's the $90,000, that's the balance in the truck. At the end of year 1, accumulated depreciation has a balance of $15,000. At the end of year 2, when we credit it again, now accumulated depreciation has a balance of $30,000. That's what's going to be subtracted from the truck. When we make this journal entry a third time, accumulated depreciation will go up by another $15,000. It'll be $45,000 in accumulated depreciation. Okay. So again, the depreciation expense is being reported on the income statement as part of our operating expenses. Accumulated depreciation is being shown to compute the book value on the balance sheet. So the book value, that's what we have left to depreciate on the asset. That's our cost minus our accumulated depreciation. So here's the truck at the end of year 1. Here's the cost. Here's the accumulated depreciation. We subtract. The truck has a book value of $75,000 at the end of year 1. Okay. And so this book value would be added to the cost of the land and the book value of any other assets that you have to get your total plants and equipment on your balance sheet.